This is Trepp Week in Review for the week ending November 3rd, 2023. I'm Haley Keene with Trepp, a data, modeling, and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Chief Product Officer. After weeks of rising interest yields and falling stock prices, the market did a full about-face this week. Stocks soared and yields on long-dated treasuries plunged. And in addition, the Fed held interest rates steady. That sure made for a good week for investors, didn't it, Manus?
Well, it sure did. There's just so much news out there to talk about and so many things. This could be a very, very meaty and dense podcast. So let's start with interest rates, which just completely fell off the shelf this week to the absolute delight of investors for both stocks and bonds. Listeners will recall that the 10-year Treasury grazed 5% a couple weeks ago. It had been marching steadily higher, putting pressure on cap rates. People were concerned that refinancing gaps, that cash in necessary to refinance a loan, was just getting bigger and bigger. The velocity of commercial real estate transactions was going to slow even further. And that still may be the case, right? A week does not make a complete trend. But what we saw over the last 4 or 5 days was a complete reversal on the long end of the curve. The 10-year rate this morning got as low as 4.62. So that's a 38 basis point dip over the course of a week. It didn't close that low, but it was a very encouraging sign that perhaps the worst is behind us now of rising interest rates. Certainly, the falling interest rates gave a huge bump to the equity markets, 4 straight days of big gains, including today's 560-point bounce in the Dow, which was the biggest gain since May of this year. A lot of enthusiasm this week across the board, and falling rates will do that. There are a couple of nuances to this that kind of get into the weeds. One of the reasons for the dip at the long end was that the Fed said it would emphasize shorter dated maturities on their new issuance. That means fewer 10-year, 20-year, 30-year auctions, which means less supply, and therefore yields on that long end fell. So it was partly technical on that point. The other nuance is because of that point, yields at the short end of the curve didn't move very much. In fact, the yield on the 2-year today ticked up a little bit. And what that means is, while at the long end, people that are looking for 10-year debt, residential mortgages, 10-year fixed rate commercial mortgages, they're happy today. And they're probably happy because this will correspond with a contraction in cap rates if this fall in rates sticks. But at the short end, those that are worried about floating rate debt or buying interest rate caps, no relief today. The short end of the curve really remained unchanged to slightly higher today. So a lot of moving pieces, a lot to go through, and looking forward to Lonnie's remarks on this.
I think Haley should have sounded the Professor Manus siren before we started the intro today, because that was a really great introduction. And I know when we talk about the macro trends on the open, usually we're pretty high level. And so it's great for you to dig down into some of the details, Manus, and maybe give some of our listeners that aren't as familiar with how those processes actually play out and what they mean some deep insight. So I definitely appreciate the education on the front end of this. With that said, I will kind of bounce to some of the high level macro stuff that we'll report on. And I think as we talk through the delinquency report and some of the stories, or maybe some opportunity for us to come back to some of the impacts of the actions from this week. You know, the Fed, as we talked about, had their meeting this week. It was really interesting when you listen to Jerome Powell talk. You know, I think he was very calculated. I got to say, the guy has done a pretty masterful job of being committed in a non-committal way. And I think he left the door open for some additional rate hikes, but didn't, come out and say that they're going to do rate hikes. I mean, I think he was very tempered in what his remarks were. And so I think it'll be interesting to see what happens with that. As you just described, Manus, the markets have taken their view and made their bets. But I think we still have, the opportunity, should numbers come in hotter than expected, that they still have that up their sleeve. For some of the macro news, private sector payrolls rose about 113,000 in October, which was, considerably less than what was expected. This was according to ADP. Labor costs showed a surprising decline in the third quarter. So cost of labor, was kind of unexpectedly declined in the third quarter, providing some relief on the inflation front. That was according to a Labor Department report on Thursday. Steven and I talked about this last week, Manis. The Treasury announced the budget deficit, last week. I said the 23 budget deficit would be around 1.7 trillion. They also announced this week that they're going to borrow an expected 776 billion in the final 3 months of the year, and they're expecting to borrow another 816 billion between January and March. So I think that's probably going to get some more headlines and have some more people talking as we go through the new transition with the new Speaker of the House, et cetera, et cetera. And then what we're watching Friday is the big October jobs report. So economists are expecting the non-farm payrolls report to show growth of about 170,000 jobs in October, which is down considerably from 336,000 the previous month. So I want to toss this over to you, Manis, and ask, are you aware of anyone that actually looks at these reported numbers and then compares that to the revised numbers that we get after the fact? Because it seems like these numbers are either way over what the estimates are, and then get revised down, or they're way under and they get revised up. And so I don't know. I haven't had the time to go back and look, but I didn't know if you knew offhand of somebody that has done that type of analysis.
Well, certainly there are plenty of Wall Street analysts that look at this and probably live for this stuff. But you're right. You're absolutely right. We get two jolts for every report. We get the initial headline jolt that we get, and then we get a jolt that tells us, the previous 3 months were revised higher or lower. And it does seem like, I don't know if you want to say the goalposts have widened or narrowed to get this thing right, or I'm not sure what the metaphor is, but, the guys that are putting out these numbers don't seem to be spot on very often based on the revision. So it is a, what do they call economics? The soft science or something like that. I think that these predictions only get you so far. I do want to make two other points about what happened this week and get your comments as well on this. The 30-year residential mortgage rate, if I'm not mistaken, peaked at about 8.13%, maybe on Monday, give or take. That's the highest I saw it per CNBC. Today, I saw it at 751. So we're talking about a 62 basis point drop. And in addition, I'm not sure that 751 reflected the lower interest rates that we got today. So we could be looking at something which is a 730 handle, a 740 handle in the next couple of days, which is a wonderful thing for people trying to sell homes. It's a wonderful thing for people that want to buy a new home, assuming that this lower rate doesn't turn into much higher prices on the sell side. It's great news for the home builders. So that's a wonderful thing. But I want to put this in perspective, and it does apply to CRE as well. When the 10-year Treasury yield drops by, I think what I said, 38 basis points, but the 30-year fixed rate mortgage drops by 60, what it means is that the spreads, the risk premiums are coming in too. It's not just that Treasury rates are falling, it means that risk premiums are tightening too. And we did see that in CMBS this week. We saw not only were potential borrowers benefiting from the fact that the 10-year yield was dropping, we were also seeing not overwhelming, but nice enough tightening at the AAA all the way down to the BBB minus level of CMBS, which means for anybody that's looking to refinance now versus where they were, a week ago, 2 weeks ago, you're probably 40 or 50 basis points tighter, which is nice, especially, as I said in the open, if you were looking at a cash-in refi.
Just to give some context, I think we've probably seen other periods of this type of volatility in the markets in terms of rates, where we're seeing the 10-year move as much as it has up and down, and then correspondingly the interest rates. Does anything jump out at you relative to other like historical markers maybe? I know during COVID, we kind of saw things blow out, come back in, but it just seems like the last 2 or 3 weeks have been really volatile. And to your point, like now it's to the good, which is great. But is there any reason for us to think that this is going to stay for another couple of weeks, or could we be looking at a situation where another, balloon drops next week and everything shoots right back up?
Well, I think that's a tremendous question. And I think the real unknown, and I'm not a technician when it comes to trading treasuries. But I do think a big part of this was the fact that the Treasury said they were going to tilt on new issuance to the short end, which means, less long dated treasuries being issued, meaning less supply means, tighter spreads, more money chasing fewer goods. But I have no sense of, is that entirely the reason for this plunge, or have people changed their perspective? Do they now believe that we are at peak inflation, peak Fed activity, the bond strike, right? People pulling back and saying we don't want to buy bonds right now because yields are going up. Is that over? I think it's probably the domain of those guys that used to build the Black-Scholes trading models for OAS, for residential, guys that have more gray matter than me. I don't really know. But let's not forget, it wasn't all that long ago, maybe, I don't know, 6 months ago, 8 months ago, that 10-year Treasury fell through the floor. It was in the mid threes at one point this year. And, I'll go back to something I said before. 1 week does not make a trend. And when it comes to stuff like this, I am definitely not a seer. I'm not the Long Island medium, and I'll leave that to other people to kind of project where we're going.
So also this week, we saw several big deals that were announced or pursued.
Yes. I mean, it wasn't just the falling interest rates that were positives this week that showed that investors were getting more frisky. We had two other things going on, one which I won't dwell on very much. One was the fact that earnings continue to come in nicely this season. We saw some very solid earnings this week, more surprises to the upside than to the downside. And I think that added to the confidence of investors this week. But something that you don't see in periods when the markets are frozen or when people are really skittish are big mergers, big real estate deals. And we saw two of them this week, which I'll touch upon very quickly. And I think that they were bullish for the market. The first one was that Healthpeak Properties and Physicians Realty Trust announced that they would be merging and creating a $21 billion new entity. That's two firms that are in the medical office space. As I said, these things don't happen when cost of capital is high, when there's a lot of volatility. And I think this is a sign of volatility in the space, at least this week, retreating. And the other one was Realty Income, which is a huge player out there, acquiring Spirit Realty for $9.3 billion. Spirit is a big player in the triple net space. If I'm not mistaken, their portfolio is about 66% some form of retail, either anchored retail or some other form of retail. So probably a lot of CVS is in there, a lot of Walgreens and others. And I do think 25% of their portfolio is industrial. So that's another big deal that was announced this week. And then there was a third deal which was attempted but fell through. Wyndham Hotels was rebuffed in a bid to acquire Choice Hotels for almost $8 billion. Wyndham may come back and sweeten that bid at some point. So what you have here are three different sizable deals being either attempted or agreed to, three different property types: retail, medical office, and hotel. And I do think that this is a bullish sign for the market that, maybe the worst is not behind us, but the trough may not be nearly as deep as some people thought it might be 6 months ago.
Yeah, I would agree with you, Manus. I think this is good news for the market. And it's interesting, the Physicians Realty Trust in that medical office space. I mean, that's, quasi office. It's not traditional office, but it bodes well for that medical office space, which we've talked about a little bit, and the resiliency and strength that market has shown as an asset class. So that's going to be a really interesting merger between those two. And then the Realty Income, as you mentioned, a nice play in the retail space. And we've seen some large deals this year with Prologis and a few others in the industrial sector. We saw student housing last year. So it's good to see the retail space and the medical office space seeing some big deal activity. I think it bodes well for the market. And I wouldn't be surprised if Wyndham comes back with a counter for Choice to try to get that deal wrapped up as well.
Yes, we're all waiting with bated breath for that office merger. If that happens, then training wheels are off and we are back to 100% risk on. We'll see if that's something that happens in the next 6 months. I'm not optimistic we're there yet, but who knows?
Well, it might not happen if we keep seeing delinquency rates like what we saw this week. We released our latest delinquency report for October, and there were a lot of moving pieces. So can you guys break it down for our listeners?
Yes, it was a very tricky report to go through, and I'll do my best to kind of work through it. We do make this available publicly, by the way. So if you're not on our mailing lists and you'd like to see this report, we will send it to you and we'll add you to our mailing list at the same time, which will entitle you to get our periodic blogs and other free material that we do circulate each week. So jumping into it, the delinquency rate moved higher in October by 24 basis points. It's now 4.63%. That's the highest reading since the end of the COVID-19 pandemic. So where does the nuance come in? There was one very large industrial delinquency that influenced the numbers considerably and blew up what was a previously incredibly low delinquency rate on that segment. I'll get into more of that. In the heavily watched office part of the market, delinquencies rose another 17 basis points. That segment is now 5.58%. Offices were under 2% at the beginning of the year. So I think they were 150 basis points, in fact. So we're talking about almost a 4x increase since the beginning of the number. In the industrial space, there was a $930 million loan that showed up as past its balloon date and not current on interest. That loan backed a 2020, or that loan was issued in 2021 and backs a single borrower deal. The loan matured this month, and the borrower has embedded extension options that could push the maturity to 2026. The loan was backed by 109 properties originally. 32 have already been released. However, the loan's debt service cost jumped from 2.55% 18 months ago to almost 10% now. And that's completely driven by the increase in LIBOR/SOFR that we've seen over the last 18 months. And that pushed the DSCR rate to below 1.0x for H1 2023. So we're just speculating here, but our guess is that the owners of these properties love the properties. They didn't qualify for a maturity extension. In order to qualify, they're going to have to pay some kind of repayment, prepayment, curtailment, if you will, of that $930 million industrial loan in order to qualify. They probably weren't able to pull that off by the October 2023 maturity date. If I were guessing, I would say that this loan cures sometime in the next 2 or 3 months and kind of offsets some of the increase we saw this month in the delinquency rate and reverses what was a huge jump in the industrial delinquency rate this month as well. So again, happy to share our report.
Yeah, I think it'll be interesting to see on that industrial deal. I mean, it's a really large deal, and as you mentioned, it kind of skewed the numbers, right? And we think it'll probably cure relatively quickly. You know, with that current debt service cost at 10%, I mean, they're going to have to modify or extend or do whatever. That rate's going to be in place. You know, it's like it's not only just they're going to have to come with some cash to buy the loan down. Effectively, they're probably going to have that carrying cost in that ballpark now going forward, at least until they refi into another loan situation. So that will be an interesting one to watch. And we haven't done any type of deep dive analysis, but I've got to imagine there's a lot of other properties that are in a similar position where even in an asset class like industrial that's been relatively strong, or actually really strong, it just shows the impact. When you're at 2.5 on your cost and it goes to 10%, that can negatively impact the property in its performance. So it'll be interesting to see. I think just overall, nothing jumps out on the delinquency rate. Obviously, it's higher than it's been post-COVID. Not great news. But to your point, like, take the industrial stuff out. There wasn't a huge jump in office, still going up, but not substantial. So I think this is probably in line with what I would have, guessed if we had taken a poll at the beginning of the month of what we would see outside of the industrial, obviously.
I think the industrial made up about 3/4 of the jump. So without that, I think we were talking about, like a 9 basis point increase or 8, something like that. We also saw a similar loan in the multifamily segment that was not nearly as big, but was a big SASB loan that also was in the same category, where it got what looks to be a temporary situation where they couldn't extend the maturity, but they do have maturity options. and that too may cure very quickly. Two more bullet points. I'll give these very quickly. Year over year, the overall delinquency rate is up 167 basis points. So it was about 3% this time last year. Year to date, it's up 159 basis points. So to put it in perspective there, if we're looking, here, I don't mind being the Long Island medium in terms of where we're going here. Even though that multifamily and that industrial could cure very quickly, I think the delinquency rate has nowhere to go but up. And that's largely because, as Lonnie has pointed out frequently, either on this podcast or in research that we circulate or in his speeches around the country, the sheer volume of loans maturing this year and next year is enormous. And we will see more and more loans kind of run into the rocks as they reach their maturity date. And it'll be very hard, given the current yield curve, for these not to avoid some kind of extend and pretend situation. But that's my 2 cents.
Unlock a historic mall investment opportunity with Spinoso Real Estate Group's proprietary platform. Their expert team excels in identifying unique opportunities and conducts rigorous due diligence. With a proven track record of operating over 80 malls and 72 million square feet, their turnkey operating platform is poised for strategic execution. Partner with Spinoso and seize this institutional historic opportunity. Explore more at spinosoreg.com. So let's jump into retail to start our property type segment. But we wanted to kick it off with some news from the latest retail earnings that painted a rosier than expected picture for the market.
This is something, I alluded to the broader picture, which was that earnings over the last 2 weeks have been better than anticipated. That's great news. Some of the tech numbers have come in very strong this week. Even today, we saw some nice bumps from some of the top companies, and that's terrific. But the ones that jumped out at me, and it mostly came from remarks on earnings calls, came from REITs that are devoted to the retail segment, and in particular, the mall segment. Everybody's heard the term for the last 5 years. Retail apocalypse has been used endlessly. There's been so much pain for retailers and landlords, bankruptcies galore, big and small. Mall values have been cut. Sizable losses have waxed some lenders out there. But we have seen over the last 3 to 6 months some signs of improvement. We have seen some more loan extensions, the borrowers leaning in and fighting for their properties. We have seen some refinancings. And now this week, we saw some really effusive remarks from 2 CEOs that are really almost fully dedicated to the mall space, one Macerich and the other Simon Property. This first one came from Macerich CEO Tom O'Hearn, and I'm quoting here, "It was another strong quarter for us. Leasing volumes continued at a record level. We had a 130 basis point gain in occupancy year over year and an 80-point gain over the last quarter. The firm pointed to 500, I'm taking out the quotes now, the firm had 500,000 square feet in new leases spanning Brooklyn, Long Island, Arizona, and California, and they called the pipeline, quote unquote, healthy. On the debt side of the business, which is, one of the things we've been watching so carefully, the capital availability, here's what they had to say. There is liquidity in the market, and been a significant amount of large and modest-sized deals that have been getting done over the last several weeks. So, Macerich, I would put them firmly in kind of the sweet spot between A+ and B, right? They are not the super high end. They're not the class C. They're right in that middle. And that has been a part of the market people have been concerned about. And for their CEO to be this enthusiastic on the earnings call, I thought was terrific.
Yeah, and it's really great, when they say leasing volumes are at a record level, and they quantify that by saying they've had a 130 basis point gain compared to a year ago and an 80 basis point gain over the last quarter. And it looks like the leases aren't concentrated in just a couple of centers. I mean, when they mention Brooklyn, Long Island, Arizona, California, that's a really great narrative. I mean, it shows that consumers are coming back to that space, they're spending their money, and tenants are signing new leases. I guess if I were to take a little bit of a, bearish look at this, I would say, like, given what we've heard nationally about consumer spending and household savings being tapped out, maybe begs the question that this is something that can, continue on this path. but I would not expect the CEO to be as bombastic in his description of kind of where they're at, given where we've seen the market. But when you look at the $5 billion of mall financings in CMBS space, I mean, you've covered up probably every single one of those on this podcast, Manus, and you've been saying for the last several months, there's been a lot more green shoot activity in that space than what we've seen in the last several years combined. So all in all, I think for Macerich in particular, really great news. And I know you're going to cover some of the stuff with Simon, which was, equally as enthusiastic and exciting as well.
Yeah, I'll pause for a minute to give a shameless plug for a future podcast. We're going to have Carmen Spinoso coming on in a week or two, and he is where rubber meets the road right now. He is the guy that they bring in as the receiver for malls that have gone sideways, that have seen occupancy fall off, vacancies tick up. And we had a chance to chat with him. I can't wait till this podcast gets done and it is released because, like I said, he's where rubber meets the road. And I did notice, I had mentioned this on the podcast several months ago, that Spinoso had been popping up over and over again as the receiver in special servicer notes, usually with a positive comment tied to their name, that leasing was picking up, rental per square foot numbers were increasing versus what was in place. And, that gave me some confidence when I started seeing these numbers, along with the refinancing and capital availability, that this is going to have more green shoots coming towards us than we ever expected 2-3 years ago. I think that is perhaps an inflection point for where we are. To be sure, I don't want to be Pollyanna here. Like, there's going to be some nasty bruises for some lenders. There's going to be some losses, and there'll be situations where CMBX shorts will be paid, no doubt about it. There will be some marks left, but I do think that the momentum right now is turning towards the retail space, and it's a great thing to see. And that's before we even get to pickleball, before pickleball starts to really take root in some of these malls. I will throw out the Simon quote. David Simon, CEO there, said, in quotes, "I don't know that occupancy will be our highest ever, but it will be within distance pretty close." So they too were feeling good about where they were going, and they represent a different part of the market. Simon, in particular, very high-end malls, high per square foot sales, and a segment which is dedicated to outlet centers as well. That's the other part of their portfolio. So great news in those segments.
Yeah, and I think it just goes to the lifeblood of that industry is tied to leasing. I mean, if the leasing velocity is there, it makes those assets a lot more attractive, and they can service the debt and be productive. When leasing dries up, it's just like pipeline for the investment sales guys. That's the lifeblood, and it's good to see both of them talking about occupancies and leasing velocity in such a positive way. So we're hoping that continues. It's great, and I agree with you. The Spinoso podcast is going to be really, really good because he comes from a practitioner perspective of being on the ground and now in operation. So I'm equally as excited as you, Manus, to get that one recorded and get that one out for the audience.
You guys are going to have to give me hand signals for that one, putting your finger over your pursed lips so that I don't give Mr. Spinoso too little oxygen. He's an incredibly articulate spokesman for the mall space, and that's one of those times I really need to stifle myself. I got to make sure that we let him really go on as long as he's willing to. So let me go through several other nice retail stories. Commercial Property Executive reported that Decatur 215 in Las Vegas sold for $36 million via a 1031 exchange. The property is a 127,000 square foot center that lists Petco, Hobby Lobby, Ulta, and Sprouts as tenants. The sales price represents $287 per square foot. The seller was Brixton. They acquired the asset 5 years ago for $29 million. The new sale represents 27% appreciation over the last 5 years. In a Salt Lake City suburb, this is from Connect CRE, the nearly 120,000 square foot Highbury at Lake Park in West Valley City has been sold for $30 million. That equates to $251 per square foot. The buyers were X Development and Midlock Investment Partners. The property is anchored by Target. I think that's the first time that particular property sold. And this comes from Commercial Real Estate Direct, our sister company, Urban Edge paid $309 million for 2 Boston area shopping centers. One was Shoppers World in Framingham. That's a 750K square foot asset in Framingham. The other is the Gateway Center, which is 640K square feet. The seller was Site Centers. Commercial Real Estate Direct reported that the sale would result in a cap rate of about 7%. They don't say what the NOI used for that number was, but it should give people a benchmark for a sale of this size. In this case, Urban Edge had sold an industrial property in East Hanover, New Jersey, to finance this 1031 exchange. That sale of the industrial property was done at a 4.9% cap rate based on next year's expected NOI. So a lot going on there. Hopefully I articulated it well enough, but some good news there in retail.
Yeah, and you notice a lot of the same tenant rosters in these retail sales: Target, Anchored, or Nordstrom Rack, TJ Maxx, Marshalls, Costco, Home Depot seem to be drawing a lot of interest, especially for these 1031 buyers. So it's great news. It's good to have some retail stories outside of the mall space that show that the market's still active there. So I think this is it's a good week for some retail sales. And I would just comment that Salt Lake City area, Manus, has really kind of cemented itself as a much more desirable CRE location, not just from a multifamily student housing perspective, but now into the retail and some of the other sectors as well.
Now, it wouldn't be a Tripwire podcast without a variety of office stories. So we have green shoots and crabgrass all across the board today.
Galore. You could say we don't just have grass, we have fescue, right? We have that 4-foot high grass that you find in the links golf courses in England and Scotland, right? It's just an abundant number of stories here. Just a little inside baseball. I run through a lot of these things, often droning on, and it's up to Haley at the end of the podcast to pare them down. So I'm never quite sure how many make it in there, but this might be an all-time drony set of stories. I apologize in advance. Let's start with the greens. We put out a trading alert from an office in Dallas. This is a 2.2 million square foot complex in Richardson, fully occupied by State Farm. It was sold to Murray Asset Global Investments, and Trez Western sold the property. The interesting thing here is that the property backed $450 million in CMBS debt that was slated to mature this month. State Farm is the only tenant. They are on a long-term lease. Their lease does not end until, I think, 2031 at the earliest. There are multiple leases in place, and some extend as far out as 2036. So there was no risk of this thing defaulting, yet State Farm had been looking to sublet space in this property, about a quarter of it, and State Farm has been giving back space hand over fist across the U.S. in hundreds of thousands of square foot parcels. So it was unclear if this property was sellable, that if somebody would come in there knowing this was purpose-built for State Farm, knowing that they were looking to sublease some of it, and that they were likely not going to be a tenant of this maybe 10 years from now, it's great to see that these two buyers have come in there or a buyer has come in and acquired it, and that should result in the payoff of a big CMBS loan. We don't have a sales price on this yet. We're trying to nail it down, but it will be very interesting to see where this comes out. This was sold for $800 million a couple of years ago. Lonnie, your thoughts on that one?
Yeah, so I think Texas is a non-disclosure state, so it's going to be difficult to get the sales price confirmed. But I saw some stuff on Twitter today saying the property traded somewhere in the $550 million range. So significant haircut from the previous trade, but to your point, enough to cover the loan and, potentially set the new buyer up for some upside there. I think the new owner was affiliated with Richard Sarvar, which was the previous owner of the Phoenix Suns. So I think this is one that we'll see it play out. It's a really nice building. It's a great location. There's a lot of really good things about it. But to your point, even with that really long-term State Farm lease in place, there wasn't a huge appetite based on the health of their company overall in the marketplace. So I think this is one to keep an eye on. I think in 10 years, we might look back at this and say it was a really great deal, but we might look back at it and say it, even at the 550 number, if that proves to be the number, that they paid more than what it was actually worth.
Lonnie, can't you, messenger over a bottle of Cristal to one of your broker friends in that Dallas market and get them to confirm that price? There's got to be something you can do to.
Yeah, I think I'm going to put my Pat McAfee muscle tee on and see if I can, get the price from somebody. So that'll be my mission for next week's pod, to have a confirmation of the sales price on this property.
There we go. So a couple more green shoots, run through them quickly. Minneapolis St. Paul Business Journal noted that U.S. Bancorp is going to maintain and renew its 440,000 square feet office at 800 Nicollet Mall in Minneapolis. Great news for that Minneapolis downtown area. The story does come with a little bit of nuance in that it's unclear whether the firm will maintain its 120,000 square foot office in St. Paul. A lease there ends in 2024, about a year from now. The fact that they were silent on that, a little discouraging. And they will also be giving up space at Meridian Crossing in Richfield, Minnesota. They'll be moving employees to Excelsior Crossing in Hopkins. For people in that market, you'll know that that property had a near-death experience a couple of years ago when Cargill left, but the owners of that property were able to revive the property by pulling in U.S. Bancorp, and now they're going to add more employees to that 300,000 square foot office in Hopkins, Minnesota. In New York, Weill Cornell Medicine renewed 200,000 square feet at 575 Lex, and they're going to add another 100,000 square feet to that property, bringing their percentage of the square footage they have at that property to almost 50%. That property is owned by Cannon Hill and George Comfort. A vote of confidence for the New York City market, a vote of confidence for the New York City office market. Scott Rexler, you might remember a couple months ago, he said some of his properties were rotary phones in a cell phone world, and that he might be giving some back to the owners. So the Real Deal was reporting this week that Rexler got a modification on a $1.2 billion loan on 1285 6th Avenue in Manhattan. His firm will be contributing $200 million to pay down the balance of the loan and to fund reserves. So this is not a CMBS loan, but it is a huge vote of confidence by RXR for that Midtown West office property. A $200 million pay down is nothing to sneeze at. And 1285 6th Avenue, while it is a Class A office, it is a Class A office that was built in the 1960s. It's not Hudson Yards. People in that vicinity have to fight to retain tenants, and that makes his vote of confidence even more exciting. In Boston, we saw 855 Boylston Street sell for $99.5 million. That sales price represents nearly $700 a square foot. The story came from BizNow. The buyer is Esden Holdings, which is Qatar-based.
So, Manish, you've referenced a couple of Boston deals. So, one, our friend Oz is probably licking his chops over there because it's good to have some Boston stories. But I also wanted to tease out, we've recorded a podcast with Matt Frazier of Jones Street Capital, based there in the Boston area. We're going to be pushing that out this next week. He's a multifamily owner-operator, has a pretty interesting investment thesis, and thought it was a nice tie-in to the Boston sales and green shoot transaction data that we've been given today. I look forward to our audience being able to listen to Matt and kind of how his firm is capitalized on secondary, tertiary, multifamily investment from his perch there in Boston.
And no pod would be complete without some crabgrass in the office. Let me go through 4 or 5 of them, and then we'll save the rest for next week. In San Francisco, this comes from The Real Deal. Gene editing firm Graphite Bio has paid a $58 million termination fee to get out of a lease in South San Francisco. The firm is vacating 233 East Grand Avenue. The firm had only taken a 10-year, 141K square foot lease last year. So my guess is they probably missed out on a patent or something that they were trying wasn't working. They laid off 50% of their staff, and now they're looking to give back that space via a $58 million termination fee. Some of that space has already been released by Health Peak Properties. So something to watch there. Also in the Bay Area, the San Francisco Business Times reports that Adobe has put 160,000 square feet up for sublease at 100 Hooper. That's about half of the firm's footprint at that location. In Minneapolis, CWT, which is a B2B oriented travel agency, has put 90,000 square feet of sublease space up in Minnetonka, Minnesota. That's at 701 Carlson Street. In New York City, Columbia Property Trust is offering 101 Franklin Street in Manhattan for a big discount to where it bought it from. This is in Tribeca in Manhattan's kind of lower west side area. The property is being shopped at $115 million, according to the Real Deal. That would represent $556 a square foot for the 207,000 square foot office. The property is likely a candidate for office to resi conversion. CPT paid $205 million for the property in 2019. So that's a 46% discount to where that property sold for just 4 years ago. And lastly, back to the Bay Area, the Real Deal notes that Cross Harbor Capital Partners has taken ownership of 55 New Montgomery Street in San Fran. Swift Real Estate Partners had been the owner. It paid $64 million for the property 5 years ago. It seems that Cross Harbor took over the ownership with a $15 million credit bid, meaning nobody was willing to offer up more than $15 million for this. This is a 100,000 square foot property, as I said, at 55 New Montgomery. So some good, some bad in the office segment, and hopefully more good to come.
And our industrial listeners already got some coverage from the delinquency report, but we do have one additional story to cover this week.
Yes, it was a very neglected segment for a long time, but we do try to have a industrial every week. This story comes from Connect CRE. Ocean West Capital Partners has acquired 5 different properties spanning California's Inland Empire and Central Valley. The firm paid $100 million for 1.83 million square feet. The properties are logistic focused in nature. The properties were all recently constructed in 2023. So that market has seemed to be pretty immune from any kind of downturn in demand for those properties, although the purchase price here, not overwhelmingly strong, but still demand nonetheless.
Yeah, I was out in Berkeley this week, Manus, and talked with a couple of folks that, lend in the space, and they were just saying the run up in rents and prices, it's just, it has them shaking their head on how sustainable this is long term. But when you look at the supply and demand metrics and vacancy hovering at 1% or 0 in some of these markets, it's going to be this way for the foreseeable future. Where effectively, you build something, you want to sell it, there's ample buyers. If you have a property that's encumbered with leases, there's upside because the rents are below market and prices don't see any price, retrenchment in the near future here. So I think we'll have some industrial green shoots out in that Inland Empire area for the next several months based on what the folks in the marketplace were telling me this week.
And then a programming note this week, in case you missed it, we released our quarterly data review with our sister company, Commercial Real Estate Direct. That is a recap of all of the CRE finance and CMBS market activity from Q3 2023. So there's a lot of great data in there. We have data on maturity volumes, delinquency and special servicing rates, some information on life insurance, commercial mortgages, and a lot more. So if you're interested in that, send us an email to podcast@trepp.com and we'll get you your copy. And then shout outs, we had a few this week. Jeremy B asked us a question about CRE CLOs, so we'll be sending you an email back shortly. Joe A was interested in some information about the PIMCO hotel portfolio, and I know Manus got back to him. He also thanked us for the podcast and said to keep up the good work. David C reached out on LinkedIn and thanked us for the podcast. Jamie D said, thanks for making such an insightful and informative podcast, and they don't miss one single episode. They did have some questions about green loans or green financing, so stay tuned for some coverage on that. Jesse N thanked us for the industrial coverage and wished us a happy Halloween. So thanks, Jesse. And Lewis B shared a Business Journal's article about 2 Charlotte malls missing their payoff date. And Lonnie, I think last week we were wishing for the Rangers, and I think you got your wish because they won the World Series last night.
Yeah, so first time in franchise history. They've been here in Texas, I think around 52 years in existence, just over 62 years. And I can tell you as a lifelong Ranger fan, really awesome experience. They broke our hearts a couple of times a few years ago. And this was really special because they beat the Astros to get there. And then kind of the interesting takeaway, their best pitcher, Jacob deGrom, that they signed in the offseason, really only pitched the first month of the season and then didn't start after that due to injury. And they effectively went through the playoffs with like two named starters and kind of patched it together. And Manis, they won every single road game in the playoffs. So I think they were like 11-0 on the road in the playoffs, which is just unheard of. And so really exciting time. They're hosting the parade in Arlington, Texas, where they play. And Arlington ISD, the school district there, has canceled school tomorrow so that all the kids in Arlington can go to the celebratory parade.
That was going to be my next question. Are you going to bring your kids down there? Are you all going to be sporting the Texas Rangers T-shirts? Are you going to be in the mob? Is that what your Friday's going to look like?
Yeah, we're probably watching from the TV screen. Like, I don't think I want to get too heavily involved with like the huge mob crowd. But I'll be cheering and watching, from the comfort of my house, not getting beer and other stuff thrown at us or spilled on us or whatever with the crazy rowdy fans that are going to be celebrating tomorrow.
Well, I have to say these parades are not all they cracked up to be. I've been to a couple of giant parades and a Ranger parade. It is really a mob. You see almost nothing and you are wall to wall with other people. And if you're claustrophobic in the least, it is a place to be. So I think you're making the right move. But congratulations, Lonnie, and your team winning the World Series. And all our listeners in Dallas that are Rangers fans, congrats on your first title.
Lonnie got his Rangers win, and now Manis will just be wishing for his New York Rangers win. So,
oh, baby.
We'll be holding out for those. And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send an email to podcast@trepp.com and subscribe to the Treppwire podcast with your favorite provider. Thank you for listening and stay well.
All right.